Thank you for joining us today on this very timely topic around cash investments and helping our clients overcome certain objections to moving out of cash and redeploying their capital in a potentially more productive manner. We know that interest rates have risen rather dramatically, more than 10 increases by the Federal Reserve Board on the Fed funds rate, taking us to a level close to 5%. And of course, that rather significant increase in interest rates has encouraged many clients to reallocate capital towards shorter-term investment options. Look at the balances in money market funds today, approaching $6 trillion. Now, there are a variety of reasons as to why clients may want to hold a larger than normal cash position. Let's review them. Number one, it provides us with the opportunity to pay current bills and meet current expenditures. Number two, it allows us to cover emergencies that are maybe unforeseen without having to liquidate assets at less attractive prices. It allows us to immunize certain known liabilities, such as college tuition expenses, with a greater degree of certainty. It can help us protect against market fluctuations when risk assets are exhibiting significant volatility. And then some investors will maintain a larger than normal cash balance as a way of engaging in tactical opportunities to redeploy capital when the opportunities are greater and to reduce their risk exposures when opportunities are less attractive. Here's one of the objections that we often hear from clients. John, I think interest rates are going to continue to go up. I'm going to wait until interest rates stop rising before I invest in a variety of asset classes. Well, let's take a look at the evidence before us. We've seen a significant increase, not only in short-term rates, but even in longer duration assets as well. And the recent evidence suggests that we may be closer to the end of this cycle than we are at the beginning. With that as a potential occurrence, how should investors think about the probabilities of different financial outcomes given this potential change in cycle? Well, we know that short-term cash investments produce a greater return than longer duration assets as the Fed is engaged in this hiking cycle. But look at how that pivots or turns once the Fed is done raising interest rates. The next objection that we sometimes hear is that I don't want to take risk with my principal right now. I'm going to take steps to protect it to the greatest degree. So when it comes to risk, the question that I would ask is, how is the investor defining risk? Is it market fluctuation? Is it a temporary decline in value? Or maybe the risk that we need to help our clients approach and to solve for it is the risk of accomplishing their financial objectives. And the question that should be asked is a significant allocation to cash assets going to help protect me against that significant risk? There are a variety of different risks that investors face. Some that are immunized with a significant allocation to cash, but others that they may be unaware of. Of course, interest rate risk is significantly reduced when I maintain a significant cash exposure. And default risk is rather nil when I keep money in secure short-term instruments. But there are two other risks that investors may be unknowingly exposing themselves to do. The first of which is inflation risk, the idea that over the long term, a significant allocation to short-term investments may not protect our clients against the ravaging impact of inflation. Our client's goal, of course, is to increase or improve their purchasing power, and cash investments have proven to be a poor protection in that regard. The second risk is reinvestment risk. Today's rates may seem attractive, but the question that I ask generically is, what do we do when that capital matures? What will the new interest rate opportunities be once this capital is available for reinvestment? Now, when it comes to risk, I think it's important for us to define it a little bit more specifically, and we'll focus on the two primary building blocks that investors and advisors use in building portfolios, the S&P 500 and, of course, the Barclays Agg. Let's take a look at equities first. 75% of the time, equities produce a positive return experience for the investor. And when they endure a negative experience, that loss is approximately 14% on average. But look at fixed income vehicles. There's a greater probability that I have a positive return by investing in fixed income, almost a 90% occurrence. And of course, when fixed income does lose money, that loss is much more muted. An average loss of 3.5% Now, how do we help our clients redeploy capital that may be in short-term instruments today to embrace the opportunity to invest it more productively? Now, we've identified 3 different ways in which to do so. The first of which is staging our various investments, not necessarily committing all of our capital at one moment in time, as a way of spreading that investment risk. Many of you have probably embraced the opportunity of dollar cost averaging, the idea being that the average purchase price that we endure is lower than the average security price of the investments being made. The second approach is a barbell approach, where we divide our resources into short-term investments that produce greater flexibility and longer-term investments which lock in a higher interest rate and maybe a greater investment return opportunity. The third approach is a ladder. A ladder is a defensive approach to fixed income investing, where an investor might build an investment portfolio of maturities that occur over each of the next 5 years. In doing so, the investor accomplishes the best of both worlds: shorter-term securities that can be reinvested at a higher rate if interest rates were to rise, and longer duration assets that lock in and protect us with the higher interest rate available today. The latter approach has proven to be a very defensive way of allocating capital in a fixed income market. We want to encourage you to have these conversations with your clients to ensure that their cash balances are suitable or sensible for their circumstances and their objectives. And we leave you with 6 different conversation starters. Number 1, what is your rationale for holding a significant cash balance today? Number 2, what are your current or expected cash needs? What are your greatest concerns about reallocating that capital into assets that may prove to be more productive? What are your expectations regarding interest rates? Do you believe that we're close to the peak in rates, or do you expect them to continue to rise from here? What do you plan to do when your current investments mature? And then finally, are there any alternatives that you may consider for redeployment? We hope that this conversation today has been helpful to you in bringing these ideas to your clients and overcoming any objections they may have. We want to encourage you to visit the PIMCO website or to contact your PIMCO account manager for additional information. Thank you for joining us today.